But the next story we're covering is another unbelievable thing is Jeremy Hunt's city deregulation plans. There are people suggesting that this idea to deregulate the city and banking could cause another crash. And I've asked Prem Sikka if he'd come on and speak about it, and he's been waiting patiently there. How are you doing, Prem?
I'm fine, and good morning, Crispin, and everyone. And it's really inspiring and also a certain amount of sadness to hear the hardships that have been indicated by earlier speakers. But that should make us even more determined to fight for a just society.
Yeah. Well, it just seems like we just don't get this reported on in the media. The kind of cases of someone with no benefits for all this time, just while at the same time the government's prioritizing deregulating banks. Now the Guardian's making out that it's inevitable this will lead to a sort of 2008 type crash. Are they being overly dramatic? What's your assessment of it?
I think that's absolutely correct. Let's just remind ourselves what happened in 2007-8. There are many factors, but I just refer to the political aspects. There was uncritical commitment to self-regulation, and the people like Gordon Brown assumed that markets will continue to regulate themselves. And Gordon Brown indeed told us that he's found this wonderful thing, which brings an end to boom and bust. And of course, that didn't really work out. Just to give you one example, Lehman Brothers, which was central to the crisis, had a leverage of 44-1. So what that meant was, for every £1 that shareholders put in, the bank borrowed 44. And if there was a 1% decline in the value of the investments, well, basically the bank is close to collapse. And if you're living in a world where there is volatility in the market values, you're inviting disaster. No regulator at that time intervened and said that there is something wrong. Now, something I've never told the people, I'm just going to tell the audience here. In May 2008, I accompanied my late friend Austin Mitchell MP, and I went to see Yvette Cooper at the Treasury. And I said, look, I have done a study of the bank collapses, especially in the mid-1970s, and I'm looking at the bank balance sheets and they don't look right. There is a serious problem here. Of course, I didn't say that they would collapse, but I said there is a serious problem. Their equity base is low. They are engaged in too many speculative things. Bear Stearns hadn't lent a penny to anybody in the 5 years before its collapse, and almost all of its profits came from speculation. And I used the phrase that you can bet on as many financial horses as you like, but all of the horses aren't going to win all the time. And sooner or later, you would be in trouble. And I'm afraid it wasn't long before Austin Mitchell and I were turfed out of the door to thinking that these are mad people. And so rest, as they say, is history. So what did the government do after the crash? It bailed out the banks, and at its peak, £1,162 billion was committed. That is £1,162 billion was committed to bail out the banks. It included 133 billion of cash and 1,029 billion of guarantees. Since then, another 895 billion pound of quantitative easing, that is new money, has been poured into banks. And the aftermath of the crash was depressed wages. So the real wages level now, the average real wage is less than what it was in 2008. And we have ended up with never-ending austerity, and there's been deep political instability. Brexit, Scottish referendum, election losses to Labour, rise of nationalism, xenophobia, attacks on trade unions. Many of these things, have intensified since. So 14 years later, we are still living with the consequences. And what is the government telling us? is going to go back to the pre-crash era. And the reason the government wants to go back to that is to do with Brexit, because they've not been able to demonstrate any tangible benefit of Brexit to ultra Brexiteers. So therefore, they are latching on this idea that all you need to do is cut regulation. Of course, regulation protects people. It introduces stability in the market. It prevents bailouts. It prevents real wage cuts. But that is not what they want to talk about. So let us also bear in mind, and in the current era, which, if you believe Jeremy Hunt, is the era of strong regulation, that is why he wants to weaken it, practically every financial product has been missold. We have had financial scandals like London Capital and Finance, Blackmore Bond, Woodford Equity, and banks have been forging customers' signatures to repossess their homes and businesses. But government wants even weaker regulation than we have now. So, and also bear in mind that we have a bloated finance industry. Let me just quote you one figure. Between 1995 and 2015, the City of London made a negative contribution to the UK economy, adding up to £4,500 billion. So contrary to the propaganda by the ministers, the city is incredibly productive. Well, that is simply not the case. Nowhere else where they had such a bloated finance industry, they have suffered the same disasters. We got bloated finance industry. So what is Hunt proposing? He's putting out a 30-point plan to deregulate. And of course, we already have a financial services and markets bill going through through Parliament, but he's proposing additional deregulatory moves. He basically wants regulators to promote international competition. I always thought regulators were there to protect the people and to hold the miscreants, to deal with the miscreants. So let me just give you a couple of examples of what Hunt is proposing. Firstly, after the banking crash, there was a talk about separating the retail and the investment side. Investment is a code word for speculation. So the idea was if the speculative side goes bust, that is okay, but at least you save the retail side because that affects households and the businesses and so on. So there was a lot of discussion about this, and eventually in 2019, as recent as 2019, the retail banks were fully kind of separated or ring-fenced from the investment side. So what Hunt is proposing is to basically smash this ring fence for what he calls larger banks. So that will be smashed for the likes. He wants to only retain ring fence for the smaller banks. That would be like the Virgin Money, TSB. Start again. Getting a bit excited here. So he wants to weaken the ring fence, and only he's saying those banks who have a deposit of more than 25 billion in total will be required to separate investment and retail arms. Rest won't. And the argument is that this would save administration and the regulatory costs. My question: if the likes of Santander, Virgin Money, and TSB go bust, won't there be a domino effect? Won't it affect the other banks? Of course it will. So this is a kind of a foolishness. And also, why would international investors prefer a UK bank, which are standing on sort of a weaker regulatory footing? They will not do that. The other thing Hunt wants to do is he wants to repeal and replace the EU era, what they call Solvency II rules. Basically means banks will need lower equity, lower shareholder funds. That was a requirement introduced again to make sure that they could withstand the losses. He wants to reduce the capital for insurance companies, and it is argued that that will release £100 billion extra, which Hunt argues would then be invested in the economy. Absolutely wrong. what they will do is pay higher dividends. They will buy share buybacks, and money will be handed over to the investors. And we are always hearing about the climate change and flooding and other problems and resulting in higher insurance claims. How would these insurance companies be able to make those claims, to meet those claims, if they have a lower equity base? So again, he hasn't really provided any answers to that. Then there is something very interesting. After the 2008 crash, they introduced something called senior managers and certification regime. So the basic idea was that the top tier of management within the firm should be ultimately accountable for the actions and the decisions of the firm. Does that mean they would be prosecuted, fined? I think that is what it was supposed to mean, but that is not what has happened. So he's now talking about diluting or even repealing that. So if individuals are not called to account, what incentives do they actually have to operate in any ethical, diligent way? We also have to bear in mind that the government has already repealed the cap on bankers' bonuses. So what that means is the more risk they take, more money they generate, they collect bigger pay packets. By the time the chickens come home to roost, in a year or two, they're moved on. They're simply not there. It is somebody else's problem. And that does not help. Regulators have to make sure that the City of London is internationally competitive. To me, that is an invitation for a race to the bottom. You've got to go for the lowest common denominator, because in the city, competitiveness is not determined by, not based on the idea that you're going to serve customers well, you must not engage in shady dealings. It is all about profits and nothing else. Now, just one other point. He wants more venture capitalists to come to the UK, claims that leads to increased investment. I think that is wrong. So let me just give you a couple of examples. There's been a £7 billion sale of Morrison's to private equity fund, and also 6.8 billion sale of ASDA to a private equity consortium involving TDR Capital and Isa Brothers. All that has happened is one set of ownership is swapped with another. Yeah. So it's like me giving you money and I'm handing the shares to you. None of that results in any additional investment in productive assets. Simply changes the ownership, who holds the controlling shares. Now the government is fooling us by telling us that this leads to additional investment in productive assets. That is something completely different. And those who are watching and are familiar with Marxist economics, Marx talked about fictitious capital. That is what is happening here with private equity takeover. And investment in productive capital is something entirely different. Okay, so the government, is not facing up to the serious question. If the UK has such a vibrant City of London, why is it that we are starved of long-term investment? So in the 2010s, the UK was third from bottom in the European Investment League. We were putting only about 16.9% of our GDP into productive investment. So here the government is playing to the gallery, but not really addressing any of the long-term issues. And I think it will be absolutely disastrous. And once again, people will be bailing out these shysters from the City of London. Private equity hedge funds are part of what we call shadow banking. There is no plan whatsoever to regulate shadow banking. There's no minimum capital requirements, no minimum solvency requirements at all, even if the solvency and capital requirements for insurance companies and retail banks are reduced. It is absolute madness. And I think certainly, we should be all opposing it. But government will try to rush it through before the next general election, and leaving Labour perhaps to clear up the mess. But I don't think we can clear this mess, because unlike the last banking crash, the next one will affect everything in the high street, including supermarkets like Asda, Morrison's, and many other stores, because they're all now controlled and owned by private equity.